Back, let's invite Dipan Mehta, Director of Elixir Equities, on the show now. Dipan, yesterday was Paytm's first ever analyst meet. The management explained its business model. They gave insight into their payments and lending business. Did you attend it? Did you have a look at what came out of it? Are you convinced? They are talking about being a free cash flow positive in the next 12 to 18 months.
Yeah, good morning and thank you for having me on your show. I did not attend the Paytm analyst meet. But yes, I think management has been making all the right comments and the right commentary, and their push for profitability is something which the street is looking forward to. But it's just that the business model is still evolving for Paytm, and it's not clear how much the payments business will contribute or how much the distribution, financial product distribution business will contribute, and what will be the impact of the lending business where they are sourcing loans for NBFCs and banks, how all of that is going to shape up. And then there was a very important development on 1st of December, the launch of the digital rupee for retail users. And that could be a game, if it is successful, it could be a game changer for the payment companies. So the entire environment is very much uncertain. And until we don't get a solid roadmap to profitability and what the numbers are looking 3-4 years down the line, I would just like to wait and watch as far as Paytm is concerned. There are other new digital platform companies which have a more specific and a clearer roadmap as to their business model, and when they will touch profitability, I think one could focus over there.
Okay, fair enough. I guess what's happening is in all these names, Dipan, and tell me otherwise if you think so, in PB Fintech, in Paytm, prices have come off so much that you're getting it's possible that you get a clean, very fast 20-30% kind of moves higher, right? Which could be trading bounces. Even PB Fintech, where we know, we had the IRDA chief telling us that their plan is to make Bima Sugam into it should be a UPI moment for insurance. So the intention is clearly to be disruptive, but even if it is disruptive, it is still a year away. And a year is a long time, right? With prices so beaten down. Go on.
Yeah, Prashant, good morning. See, I know that they want to create an insurance platform. And if you may like to know that BSE also has a mutual fund platform, okay? But end of the day, insurance like mutual funds has to be sold. And for selling that, I think that's where PB Fintech comes into play. It's not insurance, nothing you can just go out and buy. You need a lot of hand-holding and advice, and there's documentation, and there are various other factors to be considered, and the right insurance policy has to be identified. So I don't think that PB Fintech's business model is going to be impacted by such a platform. Nevertheless, you're right. I think the way the stock prices of these new age digital companies has collapsed, they are reaching a point where a significant bottom could be created. End of the day, Prashant, let's keep in mind that these are outstanding businesses. And it's just the valuation, which is a bit of a mystery how to get around that. But with these kind of corrections, I think the risk return will favor the investor who takes a slightly contrarian view and invest in these stocks with a longer term horizon, maybe beyond even 5 years or so. Because these companies have a very long runway for growth, and they can, even 5 years from now, they can continue to grow at high double-digit, high teens growth rates. And when they turn profitable at that point of time, the street will give significantly higher PE multiples. So it's an evolving situation, but intuitively, I do feel that maybe a bottom has got created. And from this point on, assuming that the commentary and the numbers are positive, you could see these companies deliver a sharp turnaround.
Dipan, good morning. Good to speak to you again. Dipan, the cement sector, that's bounced back. November was a good month in terms of demand. October was a bit weakish. So I'll have to point out that November data point is coming on a weak base because the festive season last year was in November. That said, things are looking up because input costs have cooled off as well. What's your take on this space and how would you play it? Would you stick to the big daddy, that's Ultratech Cement, or would you go for the mid-cap names or maybe ACC Ambuja?
I think every bounce in cement is a good selling opportunity. Maybe the best years for cement companies are behind them. The way they are expanding capacity, I'm sure that the pricing discipline of the past several years, maybe decades, may get vitiated. You have a large new player coming in, wanting to disrupt, wanting to expand capacity. The minute they have announced their acquisition and completed it, every single cement company has announced even higher expansion plans. And it's not that the costs are going to go down significantly. Even if they do, pricing pressure will come into play, and volumes may certainly go up. But even then, I don't think the profitability of these companies is going to improve the way it has over the past. So I'd like to avoid cement completely. If you still want to buy a cement stock, then go with the biggest one, the largest two ones, that is Shree Cement and Ultratech. I think they have a fabulous track record even during difficult times of the industry, and you could have a marginal allocation over there. But by and large, this is the time to buy cement consumers, the real estate companies, the infrastructure companies, the engineering construction companies. I think you'll get higher returns over there than in cement and other material companies.
Okay, got it. Pretty clear with your view out there, Dipan. Dipan, request you to stay with us for just a bit. We're going to come back to you. But for the time being, let's get chatting.